Welcome back to Gold Rush Reporter, my friends. I'm your silver analyst, and today we're looking at a major global move that could change the entire precious metals landscape. It's official. The United States has imposed a 25% import tariff on Mexico and Canada, while doubling existing tariffs on China. These aren't just random countries. They happen to be some of the biggest producers of gold and silver in the world. So what we're seeing here isn't just a trade war. It's a direct hit to the supply chain of the precious metals market. Now, before we dive deep into how these tariffs could reshape gold and silver prices, I want to hear from you. Do you think these tariffs will strengthen America's economy or push us closer to a financial crisis? Drop your thoughts down below. I'll be reading every single one of your comments. All right, let's break this down. Tariffs are essentially taxes on imported goods. When the United States raises tariffs on imports from key trading partners like Mexico, Canada, and China, the prices of those imported goods go up. That might not sound like a big deal, but when those imports include the raw materials we depend on, like silver and gold, the ripple effects are enormous. Let's take Mexico, for example. It's not just a close neighbor, it's the #1 producer of silver in the world. Last year alone, Mexico mined more than 6,000 tons of silver. China comes in second, producing massive amounts of both silver and gold, while Canada ranks among the top 4 gold producers globally. Together, these 3 countries supply a major portion of the silver and gold that end up in US markets. But here's the issue. The US doesn't mine nearly enough silver to meet its own demand. According to data from the US Geological Survey, America only produced about 1,100 tons of silver last year, yet it imported over 4,700 tons, and nearly half of that came directly from Mexico, with another big chunk from Canada. So when the US government suddenly slaps a 25% tariff on those imports, the cost of bringing in that silver skyrockets overnight. Think about what that means in simple terms. If an ounce of silver costs around $31, a 25% tariff adds nearly $8 more to that cost. The same goes for gold. That extra cost doesn't just vanish. It gets passed down the supply chain, affecting refiners, manufacturers, and ultimately investors. The end result? The domestic value of silver and gold inside the United States suddenly becomes more attractive because it's not subject to those extra taxes. For stackers and investors already holding physical metals, this could quietly increase the value of what they already own. It's like an invisible boost caused by policy changes rather than market hype. But there's another side to this, a dangerous one. These tariffs are not happening in isolation. They could ignite a wider trade conflict, and that brings new volatility and new risks. If trade relations between these major economies worsen, we could see supply bottlenecks, higher production costs, and more pressure on already tight silver supplies. That kind of stress can move markets fast, and usually not in a straight line. When we look deeper into this situation, the true weight of these tariffs becomes clearer. What started as a trade policy decision could soon ripple through the entire financial system, especially the precious metals sector. The US, Mexico, Canada, and China are all deeply connected through supply chains that keep industries running, and silver plays a crucial role in those industries. From electronics and solar panels to electric vehicles and medical equipment, silver isn't just a shiny investment metal. It's a key industrial resource. So, when the price of importing silver suddenly rises by 25%, the effects will be felt across countless industries that depend on it. Now, here's where things get even more interesting. When the US increases import costs on a metal it heavily depends on, it creates a two-way pressure. On one hand, domestic silver becomes more valuable because it's tariff-free. On the other hand, industries that rely on imported silver will see their production costs jump. Companies that make electronics, solar panels, and batteries will either have to pay more or cut production, both of which could hurt the broader economy. In the short term, these tariffs might give a boost to US-based silver miners and refiners. Investors may see this as a reason to pour money into domestic mining operations, which could push those stock prices higher. But the reality is that the US simply doesn't produce enough silver to meet its own needs. Even if mining ramps up, it won't be enough to fill the gap. That means the higher costs are here to stay, at least for a while. This brings us to another key point: the behavior of precious metals prices in uncertain times. When trade wars heat up, investors often look for safe havens, and gold and silver have always been the go-to assets during geopolitical tension. We saw this pattern today as the tariff announcement hit. While stock markets fell, both gold and silver ticked higher. That's a classic flight to safety move. Investors know that when uncertainty grows, physical metals hold their value better than paper assets. But let's not ignore the potential downside. A prolonged trade war could hurt overall economic growth. If businesses slow down or start cutting back, demand for industrial metals might weaken temporarily. That could put short-term pressure on silver prices, at least in the paper markets. However, in a deeper sense, such a slowdown would only strengthen the case for owning physical silver. Why? Because economic stress almost always forces central banks to intervene through lower interest rates, money printing, and government stimulus. We've seen this story before. During the 2008 financial crisis, when markets collapsed, gold and silver initially dipped as investors sold everything for cash. But just months later, both metals exploded in value as stimulus and money printing kicked in. History tells us the same thing could happen again. A trade war that leads to slower growth and more intervention would ultimately be bullish for silver. So, for stackers and long-term investors, this is a moment to stay calm and strategic. Don't chase price swings, understand the bigger trend. The tariffs are more than just a trade policy. They're a signal that global supply chains are under pressure and that real, tangible assets could soon matter more than ever. If this trade war continues to escalate, we could be witnessing the early stages of something much bigger, a major global economic shift. The last time we saw such aggressive tariff policies between major economies was nearly a century ago, during the Great Depression. Back then, trade barriers triggered a domino effect that slowed global commerce, increased unemployment, and pushed nations into deeper financial distress. While history doesn't always repeat exactly, it often rhymes. And this time, the risks could be even higher because our financial system is far more interconnected than it was back then. The United States today is carrying record levels of debt, both public and private. Corporate leverage is at all-time highs, and the government deficit continues to grow every year. When you add new tariffs into that equation, you're effectively injecting inflationary pressure into a fragile system. Goods become more expensive, companies face higher costs, and consumers start paying more for everyday products. That's inflation, but it's the kind that doesn't benefit anyone. It eats into savings, slows spending, and reduces overall confidence. Now, in a situation like that, investors tend to shift their focus. They move away from riskier assets like tech stocks or speculative growth plays, and they start looking for real stores of value, assets that can't be printed or devalued by government policy. And that's exactly where silver and gold come into play. But here's the twist. Silver isn't just a hedge against inflation. It's also a metal that industries can't live without. That dual role makes it uniquely positioned to outperform in an environment where inflation rises while production slows. Think about this. If tariffs make imported silver more expensive, industrial users will scramble to secure supply. They might turn to domestic producers, but as we discussed earlier, there's not enough local production to meet demand. That imbalance can drive prices up quickly. At the same time, retail investors and institutions looking to protect their wealth could pile into silver as a safe haven. When both sides of the market, industrial and investment, are buying at once, that's when you get explosive price action. We've seen hints of this behavior before. In early 2020, when global trade slowed due to the pandemic, silver prices initially dipped, but then surged over 100% in just a few months once supply constraints and investor demand collided. This new tariff-driven environment could create a similar setup. Only this time, the driving force isn't a health crisis. It's a political and economic one. And there's another angle that doesn't get enough attention: the currency effect. If the trade war weakens international trust in the US dollar, which is already being questioned due to rising debt and deficit, central banks around the world might start diversifying further into hard assets like gold and, to a smaller extent, silver. We've already seen record central bank gold purchases in the last 2 years, led by China, Russia, and several emerging markets. Silver could be next in line as they look for alternative reserves that offer both liquidity and protection against dollar depreciation. All these factors together point to one conclusion. Silver is positioned at the center of a coming financial storm. Tariffs may seem like a local issue, but their global impact on trade, currency, and confidence could make this one of the most significant turning points for precious metals in decades. Behind the scenes, some of the biggest financial institutions and governments are already preparing for what's coming. When you see central banks quietly increasing their gold reserves, it's not just a coincidence, it's a signal. They understand that in times of trade conflict, currency devaluation, and rising inflation, hard assets become the ultimate insurance policy. But here's what's really interesting. While gold often takes the spotlight, silver is slowly becoming the underdog that could surprise everyone in this next phase. Mining companies are already reacting to these developments. Many of them have started to cut back on exports, preferring to sell domestically or hold on to their inventory in anticipation of higher prices ahead. Mexican and Canadian miners, for instance, may face higher costs due to tariffs when selling to the US, so they might look for alternative markets or reduce output until prices justify the additional expenses. That could create a tightening in supply just as industrial demand rises, a perfect recipe for higher prices. Meanwhile, large institutional investors have been quietly shifting into commodities again. After years of focusing on equities and tech, we're starting to see renewed interest in tangible assets. Silver ETFs have seen steady inflows, and futures positions are beginning to lean bullish. Historically, when these large funds begin to accumulate exposure, retail interest soon follows. The same pattern played out before the big silver rallies in 2011 and again in 2020. But it's not just about speculation. The industrial side of silver is more crucial than ever. With the global push toward renewable energy, electric vehicles, and advanced electronics, silver's role as a key industrial metal is expanding. Solar panels, in particular, depend heavily on silver for conductivity. So as tariffs disrupt global trade and increase costs, companies in the US that rely on these materials will be under pressure to secure reliable sources. This dynamic could lead to local price premiums, as we've seen before during supply shortages. There's also a growing awareness among average investors that paper markets don't tell the full story. The price of silver you see quoted online is based on futures contracts, not actual physical metal in hand. And when supply tightens, the premiums on physical silver coins and bars can rise dramatically, sometimes far outpacing the official spot price. If these tariffs cause major supply chain disruptions, we could easily see premiums shoot up again like they did in 2020 when physical silver became difficult to find. And that's where the opportunity lies. The early stages of a supply squeeze usually go unnoticed. By the time headlines catch up, the easy gains are already gone. But the signs are here now: tariffs, rising industrial demand, potential recession fears, and inflation pressures all converging at once. For the prepared investor, that's not a reason for panic. It's a reason to act. Now, imagine what happens when all of this combines. Central banks diversifying into metals, mining output, tightening, industrial demand climbing, and a wave of retail investors realizing silver's true potential. That's when markets move quickly, and those who saw it coming are the ones positioned to benefit. So, as we pull everything together, it's becoming clearer that these tariffs aren't just a short-term political move. They could reshape the global financial landscape in ways we haven't seen in decades. When trade wars like this start affecting key commodities, such as gold and silver, it sends ripple effects throughout the economy. Prices rise, supply chains tighten, and the value of tangible assets becomes more apparent than ever. For investors who've been stacking physical silver and gold, this might just be the moment they've been waiting for. If the US continues on this path, we could see silver transform from an overlooked asset into one of the most sought-after investments of the decade. Think about it. As tariffs raise import costs, as central banks prepare for currency weakness, and as industrial demand accelerates, the limited global supply of silver starts looking even more valuable. We're talking about a metal that is essential for technology, clean energy, and monetary protection, all at once. But make no mistake, the road ahead could be volatile. Markets rarely move in a straight line. In the short term, we might see fluctuations in silver's price as traders react to headlines or temporary pullbacks in global growth. However, beneath that noise lies a bigger, long-term trend, one that favors those who understand silver's true fundamentals. The smart money knows this, and they're already moving. Central banks, industrial firms, and private investors are all quietly building their positions while the mainstream media still focuses on the latest political drama. If you're watching this and wondering what to do next, remember this: silver's strength lies not only in its price, but in its purpose. It's real, it's tangible, and it has stood the test of time through every economic shift in history. When currencies falter and inflation bites, silver doesn't ask for permission. It simply holds its value. So whether you're stacking for security, profit, or peace of mind, staying disciplined and informed is the key. And that's exactly why we talk about these things here on Mikiloi Geo. Gold Rush Reporter. To help you see through the noise and understand what's really going on in the markets. If you found this breakdown helpful, make sure to hit that like button and share your thoughts in the comments below. I'd love to hear what you think about how these tariffs could reshape the future of precious metals. And if you haven't already, don't forget to subscribe to the channel for more deep dive analysis and real-time updates on silver, gold, and the global economy. Together, we'll keep tracking these developments as they unfold. Thanks for watching, everyone. Stay safe, stay informed, and as always, keep stacking smart. This is Gold Rush Reporter, signing off.